When to stop managing a naked put? When is enough enough? Stefania had asked about naked put positions a little while ago, last week, and based on her questions, it seems that this is the strategy she's referring to. And Stefania said, when is it convenient to continue to roll or repair a position, and how to evaluate this possibility of future profit positions, or better get assigned, or is it better to get assigned immediately at the strike price of the stock and manage the position? That led me to believe that Stefania was referring to naked puts. The stock falls, we get put the stock. In that case, now we have to manage it. And once assigned this underlying stock, if the call has a strike above the break even, the premium is low. Is that correct? The stock price continues to go down. What possibility do I have? This is to address these questions because my trading plan is not quite going as planned. What other strategies should I consider? When you're looking at a naked put position and you're considering rolling it down, you're selling naked puts in your portfolio, the first thing you have to consider is a trading plan. And what I mean by that is setting exits that would be similar to what you would use in a long stock position. Many of you are familiar with Investors Business Daily, and you're familiar with the idea of the 7% stop. When buying for long-term holds for stock positions, they suggest closing if the stock falls 7% because you don't want to let it go to a 10, 15, or 20% loss. The same thing is true with a covered call position or with a cash secured or naked put position, which is simply a parity trade of the covered call strategy. I have a snippet here. This is from the description that Ernie put for the weekly naked put picks of the day shown on Power Options. He ran through various iterations and he found that after many test iterations, we found selections were best if puts were at least 2% out of the money. Strike price or stock price was in an uptrend based on the 20-day moving average. None of the positions had earnings due during the week. No special stock list, of course. And each position had a stock price loss limit of 7% at the close, similar to the IBD. Because as the stock is falling, just as in a covered call, you're going to be losing more on the underlying than you're able to get back with premium, unless you go much further out than you initially wanted on your trading plan. And we're going to talk about that in a moment. This was the iteration that Ernie found worked best with various criteria for the stock, almost identical to what you would look for if you were buying a stock outright. You want good performance, good management, stock going in the direction that you want. Don't trade the naked put just because something shows up that has the highest premium. Make sure the underlyings match the sentiment for the strategy. We are in a neutral to bullish position. Now, let's take that example I just showed. Let's say that when a stock was trading at $57 per share, we sold a September 55 put for $1.05. At the time, this put would have been 3.5% out of the money. And it offered us a percent naked yield against the cost to buy the put of 1.9%. If we were forced to buy at 55, the money we'd have to put up to cover the trade as a cash secured put, that 105 gives us a 1.9% return. Now the stock is currently down 9.6% and trading at 51.50. Is there a possibility to roll this put option now? Well, I'd be tracking it in the portfolio and Power Options. From there, I'd link to position actions and position analysis to see the breakdown of my current position. Stock is down almost 10%. My put option that was 3.5% out of the money is now 6.4% in the money. Buyback cost for my 55 put is $3.65. This translates to a $2.60 loss, or minus 4.7%, against the cash secured amount of $55. I do see a rollout opportunity, only one, where I could roll this ally position out, buy back my September 55 for $2.60, roll out to the December 50, buy back for $3.65 of a $2.60 loss, roll out to the December 50 strike put for a premium of $2.86. That's 98 days out in time to take a 4.7% loss to a 0.6% return. 98 days away. I'm going to cross at least one earnings, if not two. And that's going to risk the second part of Stefania's question. What if it continues to go down? Does this rollout work? Well, while I'm in evaluating the rollouts, I can link to simulate trade. The current position on my left, our September 55 put sold at 105. Max return of 1.9%. We're currently down 4.8%. The new position, spending that 365, 363 to buy to close. My current 55 put that's now 6% in the money with the recent decline. I can sell the December 50, which gets me back to a small credit of only 29 cents, which would be a 0.6% yield. So down at the bottom, you have the original position. It's drastically in the loss zone in red, the red hockey stick graph. And our blue hockey stick graph, of course, is what the new position would look like if we rolled down. But where am I going with this? What I likely would have done is tried to roll earlier. But now begs the question for Stefania, is it worth it to chase the rabbit? Here a few months ago was around the time that Ally was flirting with $57 per share. Never really hit that, but I'm just using this as an example because I know the stock and I know what it did. So let's say that was our trade entry right here. We got in when it was floating around $57. Box here, this red box, that's our 55 strike put. So if I had sold the 55 put here and the stock fell to 55, this is likely when I would have performed that first roll. Now, I might have been 30 days out in time. I might have been 20 days out in time. It would have cost me $2, $2.50 to buy to close that put. So I might be $1 down, and I could roll down to maybe the 52.5 at that time. Well, geez, what happens next? Now it's down here. And so the stock's trading around 50. I might have to roll down here to the 50 strike. But what did I lose? I got $1 here. Might have had to pay $2.50 or so back here. Got another premium of $1, or hopefully $1.50, so I'm near break even. But at this juncture, I'm probably having to buy this 52.5 call back, put back. I'm sorry, Stefania, the 52.5 put back for maybe $2 to $3 more. I'm putting in more money, $2.50 buyback, $2 buyback, and unless now, I might have had to go 45 days out here. At this point, I'm probably going 90 days out because I only took in two $1 or 105 premiums, but I paid out $4.50. I need a $2.50 premium at hopefully the 50 strike, or maybe even the 47.5 or the 45 to go out. And I might be 90 days out in time, as we saw with that December roll from September, to get back the premium, to roll for credit. And then what happens? It goes down here. Am I going to roll again? At this point, where are we? We were at $57 when we first entered the trade. The stock's at $47. It's dropped 10 points in a 2-month period. And we're losing money by the buyback cost, or we're drastically changing our trading plan because we're having to go 60, 90, maybe 120 days out in time now to get a new credit. Okay, well, it starts to go back up for us, thankfully. Now, if I am at the 47.5, let's say December put, am I going to be able to buy this back cheaply? The 47.5, because the stock's now back up to 55, it still has a lot of time. I've lost some premium on it, but it's still probably got 90 days to go. That's tough now. It's still going to have a high premium, even at the 47.5 or the 50 strike. And if I did roll up, what happens now? We're right back into the loss area. And this is when it's important to evaluate the trading plan. And the question that Stefania asked about, when is almost enough enough? Let's consider the trading plan. If I'm doing naked puts going 1 or 2 weeks out in time, maybe even 30 days, but I'm looking for positions with around a 1 or 2% yield with protection. It's the only protection I have in the naked put strategy. My range out of the money, how far I am away from the current stock price. Am I 3%, 4%, 6%, and having a high probability on potentially a lower volatile position, not looking for the one that has the highest premium and can fluctuate the most drastically with the highest IV. That's great if it works out, but those positions tend to fluctuate against you more often. We're in this decision-making process of, do I have to roll now? How far do I have to roll to go? Now, you may be opening 3 to 4 positions per cycle. I don't know your account size, Stefania. I don't need to know. I'm not your advisor. I'm not a CPA or anything like that. But In general, if you have a core holding in your account that's maybe married puts, covered calls, the capital intensive positions, you might have 4 or 5 positions, 3 or 4 positions, depending on your allocation. In our example, one went bad. It was a loss of about $260. If my average stock price is around $50 and we're getting around 85 to that 105 premium, around $50, $55 stocks, that's that 1.5, 2%, 2.5% return in premium. It fell 10% and I'm down essentially 6.4%. I'm down $2.60. If I'm averaging a premium of 105 or 110, that next cycle that's 7 to 14 days out, if I average that $1 105, I've made back that 260 loss on this one trade without having to roll out to December. Just the next 7 to 14 days out in time in that case. And that's why it might be better once you've hit that trigger, maybe a 7 to 8% decline from where the stock initially was when you sold the put, just as a lot of people suggest, if you're buying stocks for long term and hold, and the stock falls 7% on your position, you want to consider exiting because you don't want to let the loss get too big. Do you want to continue to chase the rabbit down by rolling down naked puts, or the same thing, Stefania, allowing it to be assigned and then looking to roll down to the covered call? That's an opportunity. But if the stock continues to move down, you're losing more on that stock purchase price or on the cash secured value of the put than you're gaining by rolling to a new premium, unless you go 90 to 100 days out in time. General rules. Just like I would do in a bull put credit spread, I'd consider rolling or looking to roll my naked put before it goes in the money. The 1% rule. $55. What's 1% of $55? 55 cents. If the stock fell to $55.55, that's when I'd look to roll. And then at 52.50, if the stock continued down, which it did, my 1% rule in this case of, about 52 cents, I'd probably look to close the position if it then dropped down to 53, and so on and so forth. Not letting it go in the money. But when I hit 7%, it's clear that the stock's not doing what I expected at this time. I want this part of the graph. I don't want this for a naked put position, a covered call, or any management you could use on the naked put or the covered call. I want this. That's what I'm looking for. And that's what I want to see. So rather than roll out an additional 45, then rolling out to 60 days out, then rolling 90 days out or 120 days out, look to make up the loss following your trading plan with the different stock positions. Different stocks that match your criteria are giving you that 105 or that 1.5% return in that case, so that you make it back shorter term. Yeah, it might take 3 positions to make it back, but I'm not going 90 days out to repair a $2.60 loss with my naked put positions. Now, I want to clear something up here. I'm going to take a question real quick that came in related to this. And we still have a couple more slides here. I want to go back for a moment. James had just asked, as a follow-up, I have heard it's dangerous to sell naked calls. Why is that? It's a trade-off. Okay, so what is a naked call? Naked call is the opposite of a naked put. And we're selling, the naked put here, similar profit and loss chart to a covered call. It's neutral to bullish sentiment. We want the stock to move up in price. The stock falls 7, 8%. Hey, we still keep that 2% premium. We might only be down 5 or 6%. Naked call is the opposite. And the reason why people say, and I agree with them, why it's very dangerous to sell naked calls. And James, why you can't do the opposite of naked call unless you're on level 4 trading and have that approval. Now, I can do naked puts, for example, level 2 trading in an IRA, sometimes level 1, depending on the broker, as long as it's cash secured. Can't do a naked call unless you're on level 4 and have a certain cash amount. And the reason why is because when sudden good news comes out and stocks suddenly spike up, what do you have on this side? You have infinite risk. I know the stock could go bankrupt. The stock would fall to $1 per share. Don't I technically have infinite risk to the downside? Yes. But with large sudden gaps up and sudden news, you see some stocks that jumped the past 2 days 29 or 30%. Affirm, AFRM today up 30% on earnings. Of course, you wouldn't sell a naked call on earnings, James. I understand that. But this is the reason why brokerage houses, investors, and even Ernie and I would say the naked calls are the riskiest thing you could do, because by definition, it has an infinite upside loss. Because the stock could go to infinity. And as I always joke, I haven't seen that yet. But if I find the stock that's going to infinity, I'll let you guys know. And if you find the stock that's going up to infinity, please let me know. I'd like to take a part of that on the long side rather than selling naked calls against the position. Well, even at 0.7 delta, no, James, you do the opposite. You look at 0.3 delta. Yes, it doesn't matter the delta. If you're not on level 4 trading, you can't do it anyway. But aside from that, James, what we're talking about here is that infinite risk still exists to the upside. And you'd be looking at a 0.3 delta further out of the money, 75, probably an 80, 85% probability. That's just why. Good news comes out, sudden good news on the market comes out, stocks jump 5%, you're now in the money, even with a delta of 0.3 on the call, an 85% probability. They move that quick. Now, do they move down faster? Yes. When the market decides to turn, James, you're absolutely right. But if a stock falls 10% again, I'm only looking at a 3 or 4% loss to the downside. Another reason why they probably don't want you to do naked calls, I don't mean you, James, but why brokerage houses and a lot of people talk about not doing the naked calls is because you end up being short the stock if you're assigned early, if it suddenly jumps. Now you're technically borrowing shares of stock from your broker, and you're paying a commission on that to be short the stock. So that's just why it's said that those are bad idea to sell the naked calls, and not many investors do it, not only because the level. We're going to talk about this a little bit more for Robert in a few moments. Rules for exiting the naked put position. We just reviewed those. Now, if you're looking to roll the position, one thing you have to consider is reevaluate the stock. Look at it brand new. Don't consider you're in an existing position. Look at the stock brand new. And what do I mean by that? Now that the stock has done all of this moving around, if you looked at it right now, would it match any of your criteria to sell a new naked put on this position? If the answer is no, if you don't think the risk is worth it, don't roll. Close it, move on, make it back with the rest of your trading plan. If it doesn't match your sentiment that you would do to get into a new position, don't roll into a new position that's the same strategy. Now, Stefania had that follow-up question. Once assigned the underlying stock, now that I'm a stock owner, had to be forced to buy Ally at 55. My cost basis is 53.95 because I kept the 105 premium. If the call has a strike above the break even, the 55 strike call is above my cost basis of 53.95, that's going to be a lower premium. That's right. It's out of the money, my 55 call. Now that I'm converting it to a covered call position, it's further out of the money. This one gives me a roll to go to October, but the 55 call is only at 71 cents, not making back the premium. Even if I went out to December, the 55 call wasn't making up the 260. But this shows me a positive profit if now that I'm put the stock, and I just put the long stock into the portfolio tools and power options and link to the position analysis to see my rollouts, if I'm only getting 71 cents, my cost basis is 53.95, how can I make 3.3% return? That's including the intrinsic value. That's the max return if we were signed at 55. If it goes from 51.50 back up. You're right, Stefania. What happens if it keeps going down? Well, I keep the 71 cents, get my cost basis down to 53.25, 53.26, but I'm still losing more on the stock than I'm gaining on the call premium. In this case, if it fell down, of course, to say $50, what am I losing? I lost another $1.50 on the stock just to see some decay on the 70-cent premium. And that's the case. Now, could I sell at 50? No, because my break even is 53.95. The October 50 is not at 3.95. Neither is the December. If I did that, I'd potentially be locked into a loss, and that's not what I want to see either in that case. That's where it gets tough. But you're right. Because the stock's fallen, the new call above my break even, 70 cents, 50 cents, go 2 months out, 80 cents, $1, go 90 days out. Yeah, you're still not making it back. And that profit you could see is based on the stock going up to that strike price and getting assigned for the new max return. Now, this is to address my question. My trading plan is not going as planned. What other strategies should I consider? Well, first, Analyze first what stocks you're going for in the naked put strategy that you're using. Don't go for the highest premium and the highest return, something that has a high implied volatility, which means there's risk in the position. The market knows that there's some event coming up that could cause a wild fluctuation in the stock. Look for the safer criteria. Look for the same criteria you would consider to purchase a stock. I want a stock in an uptrend to meet the sentiment of the strategy. I want maybe a good market cap, good average stock volume. I want to see a positive earnings per share growth, reflection of good management. Yes, I want a good premium. Absolutely. But I don't want to say, oh, well, here's 10 stocks and this one, is a $50 stock and the 48 put is a 4.7% return. And here's a $50.10 stock and the 48 put is only a 1.9. Look at the fundamentals. Find a stock that matches your goals. The highest return is not always the best trade, which may be some of the reason you're getting caught. Look at your trading plan. What is your exit strategy? Are you just planning on rolling and rolling and rolling and just consider to continue rolling without stopping and saying, at what point am I no longer bullish on this stock? That's when you should close out, take the loss, make it back with other positions. If you are considering rolling, you should do it at the 1% rule. The stock falls to within 1% of your short put strike price. Don't let it go in the money. If you can avoid it, the stock falls suddenly overnight, you wake up and you're in the money, yeah, you might want to consider rolling it. But again, why did that fall occur? What was the news that caused that to fall? If that changed your sentiment, maybe just close, make it back with other positions. If the stock has fallen more than 7%, say in a 20-day or 30-day time period, or even in a 10-day time period, depending on what expiration you're using, consider just closing and getting out. If rolling, look at the stock brand new. Does the current chart match what you would use for a new entry and new neutral to bullish sentiment? And then, of course, evaluate, can you make back the loss you're taking on this position with just 2 to 3 new positions in your trading plan, whether you're going 14 days, 20 days out, or next expiration. If you can make back that loss with 2 of the trades that are 30 days out, keep your same trading plan, take the loss on this one, open your 4 or 5 trades for the next cycle. If 4 out of 5 are profitable in that case, you've made back the loss on this one, a little profit, and you can look to evaluate that other one that didn't go in your direction. Lastly, you're concerned about loss. It's not going the way you want. Maybe your losses are outpacing your gains. You're rolling too often. Well, in that case, what other strategies might you consider? You might want to consider more protected positions, directly the long call or spread. Buying a stock, selling an at or out of the money call option, or maybe even slightly in the money. I might buy DAR at 70.69, sell the 70 call, and buy a 65 put, 1 month out or the next expiration. I have a controlled risk. If the stock falls, I know I can't lose more than 4 or 5% on the position. And if it stays the same or moves up as I'm expecting, I might still be able to see that 2.5, 3% return if assigned on the trade. But I've controlled the risk. So if it goes down, I don't have to worry, oh, should I roll it down? Should I do this? No, I'm going to take this small loss and I can make it back in 1.5 or 2 trades. Just keep the trading plan if that matches your goals in those situations. Or longer term hold, a stock you're bullish on more longer term. Consider the married put position following the rules in the blueprint in radioactive trading. Buying a stock and buying a far output to keep your risk in the single digits, under 8%, under 7%. It's an April put, 216 days out, still gives me a controlled 6.7% risk, still have upside potential profit. This is the worst case scenario. If I held the position all the way to April and my stock was below 75, worst I could do is lose 6.7%. If I exit in October, I'm still keeping 180 days of time value in the 75 put. My loss might only be 2%, 1.5% on the position. And since I own stock like I do in the long collar, what can I do now? Well, I can sell calls against this near term to start paying for this position and start lowering this risk. There's other adjustments in income methods. The put's not just a wasting asset in this case. It is on a long collar. But on this proper married put approach, that's a second working asset that I can manipulate by rolling up or down to take profit on the put or to give myself a lower risk on the trade. I could move it closer in as well. So it's a second working asset. It's not just a wasting asset, as is doing just a 30-day out standard collar position. So those should be some things you might want to consider in that scenario. other strategies there, Stefania, that you might want to take a look at.